What's going on, one and all? It is Seedling Space here, and today we're talking about Astra Space. Normally, we like to talk about all the cool activities happening in the space industry to keep y'all up to date on the technological advancements and possible investment opportunities. And that includes today, Astra Space, as we're doing a deep dive into their evaluation, are they a good investment right now, and figuring out the whole gamut A to Z. So diving right in, we see that Astra Space was actually founded in 2016 by Chris Kemp and Dr. Adam London. But this is actually a reincorporation of Ventions LLC, which was founded over 10 years prior. Now, since their reincorporation in 2016, they have changed their business goal to mass produce small, non-reusable rockets with a reliable performance. So instead of using rocket reusability to drive down the cost, their focus is on an inexpensive building process and a streamlined, efficient production using lightweight aluminum to be able to drive down the cost and make it cheaper per mission. Now, to make that goal happen, it requires a lot of money to put all the infrastructure in place. So in 2021, on July 1st, they actually went public through a SPAC merger, which brought about $500 million in cash and equivalents onto the table so that they now can focus on mass producing rockets at a large scale. Now at this point, before we hit the fundamentals, let's talk about the rockets, because so far they've done a lot of work in trying to get rockets working, but they've run across a lot of obstacles along the way. So let's go ahead and dig into what that kind of looks like. So their first launch ended up failing after 27 seconds and then fell back to the launch site. Additionally, rocket number 2 also failed about 30 seconds into flight and fell back to the launch site, and both rockets were reported as failures by the FAA. The third rocket was a part of a DARPA launch challenge with a prize of $12 million, and 3 teams ended up submitting. However, none of the teams were able to launch by the launch date, and so they missed the opportunity for the prize, and no winner was ever awarded. But in good spirit, Astra tried to still go for the launch even afterwards, even though they knew they wouldn't win any money, just to prove that they could. However, unfortunately, the rocket ended up burning on the ground and never actually launched. And this was due to a fire that started during the detanking of fuel during a pre-launch countdown test. But at least there was no payloads on board. Then we get to rocket number 4, which had its engine shut down also at the 30-second mark after launch and exploded on impact at the ground. And this was due to a software bug in the guidance system, which took it off course just slightly before it was expected to. And what's cool is this one was actually caught on camera so we can see the explosion. However, number 5 actually was a successful launch in that it passed all the way through the Kármán line and reached the target altitude. Unfortunately, the upper stage still failed, so the overall mission did fail, but the first stage was the first successful launch compared to all the 4 preceding. Then rocket number 6, which I'm sure you've heard about, is the one where one of the engines had failed during launch while all the others were running, and it ended up drifting off sideways and eventually going up. And this was for a launch for the Space Force. So unfortunately, they ended up shutting the rocket down after so much time, just for safety reasons. But rocket number 7, which was another attempt for the Space Force, which they just happened last night, ended up being a successful and a very, very nice launch, both first stage and the upper stage. So with this success, they're now looking at all the launches they have coming up, which is they have some for the Space Sciences Lab for UCLA, they have 3 launches for NASA, a few for Spire Global, and even a few for Planet Labs. So 2022 is going to be a busy year. Now we have to recognize that they took a lot of rockets to be able to get to a successful launch. But this could mean that they've now figured everything out and have a potential of now generating revenue, which will keep the business going and turn it into profitability. And now I think this is a good segue into looking at what do their fundamentals look like. Now, as I said before, they IPO'd in July, so the first day of quarter 3. And through that SPAC merger, they ingested about $500 million in cash and equivalents. So then what we have to do is we have to look at what the third quarter looks like, which is the most recent results, compare it to previous quarters, and also look at what the expected quarter 4 is going to look like, as well as the future, to see, is it moving towards profitability? Is it becoming a likely business that we, as investors, should put money into? Now, we have to understand that this company is still a startup, even just 5 years in. But up to this point, they actually have not recognized any revenue. Now, I've actually gone and read the earnings reports in the SEC filings, and what they've said is that they will not recognize revenue until all services have been rendered, which could potentially mean a successful flight. Now, we have seen an increase in research and development expenses, and that should be expected as it grows and begins to focus on how to generate revenue. And they're constantly doing a lot of changes to their rockets to make them more reliable, so this makes sense. Now, one thing I want to point out is the EBITDA has consistently gotten more and more negative, and a lot of this is impacted by further and further spending on the research and development as they try to hit the production rate that they're aiming for. For those of you who don't know, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And a lot of times this is used as a metric over net income just because it provides a cleaner look at how things are moving, and especially if they make it adjusted, which is a non-GAAP measure, which helps you see the exact trend of the business. So you might be wondering, well, why does that matter? Well, in quarter 3, they received a non-recurring income of $25 million, which ended up skewing their net income. So as we see, the net income should be continuously getting more and more negative as they spend more and more on research and development without reporting any revenue. And we see that in quarter 2, they reported a negative $31 million in net income, but then in quarter 3, only negative $16 million. And that is due by the non-recurring income that they've received. Now you might be wondering, well, how can they receive income but not report on the revenue? Well, the revenue is really only for reporting their normal operating income based off of their business. If there's something that's non-recurring or is kind of one-off events that doesn't really fit into their normal business model, then they have to report that on a different line item. And this made such a big deal because it made their earnings per share look phenomenal. So in quarter 2, they had negative 47 cents earnings per share, but in quarter 3, they only had a negative 6 cents, which made it look way better than it actually was. And so this helped influence the reason why in quarter 3, Astra's stock price actually increased a lot, because at first glance, it looks like they had better earnings. So if we now move over to what are their quarter 4 guidance, and this is likely their first quarter where they're going to report revenue based on this successful launch. We recognize that they're not profitable, meaning that of the $500 million they got in July, they're slowly whittling it down because they're at a burn rate. And this should give them about 7 quarters of cash, so about 2 years of operation before all the cash that they've accumulated from the merger is gone. But the upside to that is that once they start generating revenue and start to slowly get closer to profitability, they will extend that, and hopefully it's enough so that they can get to profitability. Now, their rockets has been a wild ride over the last few years, but lately, so has their stock. Even before the merger, their stock hit over $22 and as low as $7. And since it's trading at $9.53, it makes us wonder, is now the time to buy? Currently, there are only 2 analyst estimates out there, one putting its price target at $9 and has it more of a sell, and one putting it at a price target of $13 and putting it as a buy. So we don't have a lot to go off of. So the numbers alone aren't good enough for us to want to invest in, and the market's really heating up with competitors. However, I do think what could be a good investment is buying in on the fact that they will be generating revenue, they have many planned flights for 2022, and they're still somewhat early compared to some of the other competitors. And at a market cap of only about $2.5 billion, I think that there's definitely a lot of upside as long as they continue to have successful launches and be able to build that backlog of more business coming in. Unfortunately, if you invest in them, you have to understand it's extremely speculative and there's a high amount of risk. So at this point, you should do your own research and determine if this is a right move for your portfolio. But I hope the information we provided helps you make an educated decision on whether you should buy or not. Anyways, ending it here, this is Seedling Space signing out.